Jess asks, if you're back paid for 7 years of incorrect pay, do you need to amend the last 7 years of tax returns?
No, you don't. So income is derived when it's actually paid. So just because it relates to a different year, when you're actually receiving the money, that's when it's taken to be derived. So you don't need to amend 7 years. You just include it in the current year. It shows as a lump sum e-payment on your payment summary, and you can get a tax offset as well, which will help because you've got some other income that is now added to your other taxable income.
So are we saying that that tax offset will not penalise somebody because they've received this lump sum? They may go into another tax bracket, but if they had been drip fed that money each year, they may have paid less tax. So that's why there's a tax offset?
Yes, exactly. So the intention with the offset is to smooth out that tax so you're not penalised for receiving it all in one lump sum. So there are a few conditions though. The payment needs to be more than $1,200 and you need to have received it, which relates to the last at least 2 years prior, and you need to be a resident at the time of receiving it. So there are a couple of conditions, but the intention is that it reduces your overall tax implication because you're getting it all now rather than the previous couple of years when you should have received it.
Yeah, 100%. Nicole, what happens if someone didn't lodge a tax return last year? Can you lodge two at the same time, or do you just put both of them into the one? How does that work?
No, so you definitely need to lodge a tax return for each year, and there are due dates for lodgement. If you haven't lodged your return by the due date, or for some reason, whatever, you are lodging two at once, you do definitely need to lodge two separate returns. You just need to be mindful that you could get interest and penalties charged, and particularly if you have a tax liability, there may be the penalties. So usually they will just charge some interest, may not charge a penalty, but that's all up to the tax office
some discretion.
Yeah, whether they do it or not. But definitely don't put it all in one return. It needs to be in each individual return.
Yeah. And I guess with the way technology is now and the digital payments to the ATO from your employer's bookkeeping software and whatnot, it would be very it would be hard to put it all in the one return anyway.
Well, particularly with the income, that income is
it's financial year, right?
Yeah, and it's financial year, and you would be surprised at the amount of information the tax office actually get. So they know the interest you've received, the dividends, the payment summary income. They also know if you're a contractor. The people that you are contracting to, they lodge a taxable payments report that tells the tax office how much you've actually received. So the tax office know lots.
It's so weird,
and you
isn't
really
it?
It's really tricky to put that additional income all in the 1 year. You could put expenses all in the 1 year because the tax office don't know that, but that's not right. You need to allocate those expenses against the income that it's earned.
The wild thing is, if someone did do a tax return late, so what you're saying is they could penalise you for that, but if you did owe money for that financial year, they might back pay or back charge interest. Now, the wild thing is I would hypothesise that if you did a tax return late and they owed you money, they wouldn't pay any interest on top of that money.
Oh, no, not usually,
Yeah.
but, the tax office is a funny beast sometimes. Sometimes you do, sometimes you see that sort of thing coming through.
So there is a discretionary play sometimes.
Oh, sometimes it is. It's a bit hard because sometimes we see that happening and then other times you don't. So I would say try and get your return done by the due date. That saves all the issues. I know life happens at times and it is a bit tricky, but the idea is that you get it lodged by the due date.
So the end of the financial year, obviously, well, for some it might not be obvious, 30th of June, the new financial year starts on the 1st of July. If you don't have an accountant, what's the due lodgement date?
31st of October.
Right, so you don't have long.
No, not really. And it's important to make sure that you wait for the information to come through. Make sure you have everything available. And I also would not lodge your return straight off the bat, straight after 1st of July.
Yeah.
Give it a couple of weeks because of all this information the tax office have, you need to make sure that it all comes through properly. Unless you have very specific records and you know that that's right 100%, then that's a different story. But yeah.
Yeah, and we might swing back around and touch on that. Shirley, do you have to lodge a tax return if you're 15 and below the tax-free threshold? So Shirley's either 15 and listening, what up, Shirl, or a child in her life.
Yeah, so if you haven't had any tax withheld and your income is under that tax-free threshold, which is $18,200, then no, you don't need to. There are different rules though if you're under 18 and you've got unearned income. So that's like interest or dividends or trust distributions. You can only receive $416 of that income. So there will be tax payable if you have that type of income and it's more than the 416. So if it's just normal wages and salary, you know, the kids are working at Macca's or whatever they're doing and they're under that 18 and they're under that threshold, then no, they don't need to.
Cool. James asked, if your side hustle has made a loss, can you deduct your expenses against your regular income, or do these losses get carried forward until, I guess, the side hustle makes money?
So there's a few rules that you need to be aware of. These are called the non-commercial loss rules, and there are 4 tests that you need to look at. You don't need to meet all 4, you just need to meet one. So one of those is that there is more than $20,000 in sales for the side hustle. That's excluding GST. The second test is you've made a profit 3 out of the last 5 years. There is real property involved in the business or the side hustle, which is that it's more than $500,000. So that's like if there's land or buildings, other assets that are used in the business. And then the last test is...
Nice side hustle if there's a 500K block of dirt or property.
I know. Let me just go. The last test is that there are assets in the business worth more than $100,000. And so when you say side hustle, this also incorporates other businesses that are making a loss. So this is in your individual name, and it includes the side hustle. So when you're looking at, can I claim these losses, you need to meet one of those tests. And so they're the 4 tests, and they apply to like a real business that's not just a side hustle. So it's important to make sure you're aware of all of those things.
Yeah, and I mean, if you are side hustling away and the money is starting to come in and you do have the curliest of little questions here, it might be worth paying an accountant a few $100s. You can claim that fee in the next financial year, or if they charge you before for the following year or whatever, it's deductible.
Absolutely.
But what I kind of try and tell people is with the side hustle, it basically just all sits on your TFN.
Yeah, exactly.
And even if you're a sole trader, it's all on that tax return, right?
Yes, and that's why it's important to look a bit broader as to, well, what are the rules? Because it incorporates more than just the side hustle. So if you do have a loss and you meet one of those tests, then that loss is applied to your other income. So if you have wages or dividends, interest, anything like that, the loss is applied. But if you don't meet one of these tests in a side hustle or a business, then you can't claim it. It just gets carried forward until the next year, and then you have to apply these tests again.
Awesome. Well, this episode is brought to you by Sphere Home Loans. Hey, we are mortgage broker friendly. We recommend everyone for their lending goes to see a mortgage broker. If you haven't had your loan reviewed in some time, go back to your own broker if you've got one. We are pro broker. If you do not have a mortgage broker and you've gone direct to a bank or lender, what about you get Sphere Home Loans to run their eyes over your mortgage if you haven't done so in a few years? Because, you know, we are entering an environment where rates are coming down and potentially more. So there could be some movement at the station. And You might want to buy your first home, upgrade, downgrade, side grade, buy an investment property, Sphere Home Loans. You can search Sphere Home Loans wherever you do your Googling, or there's a link in the description, show notes and all that stuff. Who are we talking to today?
My name's Erin Davis and I am a money mindset coach. I help women create a grounded rich girl life. So that is creating their own version of rich. It is looking at what's important to them, and it's not necessarily money in the bank. So money in the bank is important and the systems and processes to have the money are important, but what is it that creates a rich life for you? So it's a blend of money mindset. It's a blend of accounting. I am a qualified CPA accountant, practicing still. So I understand the numbers, but there is so much more to it than just the numbers. So you can find me on Instagram over at Erin Davis Money, and you're listening to Money, Money, Money.
You're listening to Money, 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 or as the regulars like to call us, M3. Everything discussed on the podcast is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I host this show and a show called Retire Right. I've also got a book called The Quick Start Guide to Investing, which you can check out wherever good books are sold, or there's a link in the show notes. Otherwise, thanks so much for listening today. Now on with the show. Okay, super is a super duper thing. Here we go. Joe, should a 17-year-old earning around $1,500 a month voluntarily contribute to super to get the co-contribution from the government?
Yeah, so super is a beast all by itself. And yes, it could be beneficial. So there's a huge benefit, obviously, to starting early with superannuation. So the earlier you can contribute, you get the benefit of compounding. So that is really one benefit of having superannuation contributions. But the co-contribution is that the government will match 50 cents for every dollar you contribute up to the cap. So your taxable income needs to be less than $43,455 to be eligible for the full $500 co-contribution, but you have to contribute $1,000 to get that $500 back. There is a gradual reduction. So between $43,455 and $58,445, it reduces. You also need to have at least 10% of your income coming from wages or business to be eligible for the co-contribution. So yes, if your income is under that threshold and you contribute $1,000, the government's going to give you $500. And for a 17-year-old, that's a handy little boost in the account. If you're able to do that for the next 5-6 years while you're building up, maybe you're studying, got a part-time job, then that's just really going to kickstart you in that whole superannuation lifetime journey.
Yeah, I would not see any reason why Joe wouldn't be encouraged to do that. Meets all the work.
That's all the criteria.
To be honest, it's a great teaching point and a great habit. $100 a month, Joe, bam, into super. Guess what? 50% return.
Exactly. And what are they going to do with it otherwise?
Minecraft, Roblox. What are other
Takeaway,
things?
food. My kids buy food.
I don't even know
what they go and buy.
17-year-olds play and all that stuff. Scott, chat about notice of intent to claim or vary a deduction for personal super contributions. Scott, don't tell me what to do, but let's chat about it. So chat about notice of intent to claim. So what are we talking about here?
So a notice of intent to claim is a form that's lodged with your super fund. It's letting them know how much you want to claim as a tax deduction in this financial year for a personal superannuation contribution. So these are contributions that you've made from your after-tax wages. It's not through your employer. It's not salary sacrifice. This is money that you have paid and you've put in because you're going to claim a tax deduction for it. So you actually need to tell the super fund what it is that you want to claim for them to be able to approve it effectively.
So I just want to unpack that a little bit. The concessional contribution cap is $30,000 for this financial year. If somebody had, round numbers, their employer put in $15,000 as their normal SG employer contributions, they've got a $15,000 leftover cap of the cap. There's a couple of streets that lead to Rome. They could say, I want a salary sacrifice, $15,000, and that happens each month. And then at the end of the year, well, they've put $30,000 into super at a 15% contribution if they earn under $250, but keep that aside for now. However, if you are potentially self-employed or you might have an offset account and you're like, I just want to keep cash heavy throughout the year and then I'll make some strategic decisions in June each year, you can then say, okay, it's June to 30th of June, I've got $15,000 cap left over. So what we're saying is you can put that $15,000 of your own money into your super account. Mm-hmm. Then this notice of intent to claim, you log into your super fund probably after the 30th of June and tick the box that I wish to claim personal deductible contributions. That $15,000 has sat in your super account. You tick that box, automatically your super fund will take 15% tax off that. And then your income, if it's $100,000 a year, you will then effectively, your taxable income isn't 100, it's 100 less $15,000 that you've claimed on tax. It could be less $5,000 for some donations. Your taxable income's now $80,000.
Yep, exactly. So it is.
So both way leads to Rome.
Yeah. And like you said, the intention, what do you want to do with that money? How do you want to use it throughout the year? It's a really good strategy if you want to get some extra money into super. And it's also beneficial because you get to claim the tax deduction too.
Overall, between your personal tax file number and the tax in the super fund, for your life, you'll pay less tax overall. Now, we won't touch on it now because it's less about tax, but it's just a flag that you can look back at the last 5 years and see the gaps. So if you had $50,000 cash and you've got $50,000 worth of unused concessional contribution caps, you can, and that's it, and this is, I pulled that thread, Erin. If you sold a property that financial year and some cash landed in your bank account, you could theoretically pay $50,000 or more, some of the profit into super, use those concessional contribution caps to release your overall tax position after the capital gains tax for the property outside super.
Perfect. And it is really about looking at, well, what did I contribute or what has been contributed for me for the last 5 years? And that unused cap, concessional contribution cap is what you can use. So some years it may be, such a random figure like $10,152, and then the next year it's $20,392. So it's very specific, and it's important that you know exactly how much of that unused cap you do have before you make the contributions, because the taxing of it is different. So you want to be able to claim the tax deduction if you've got the cash, but that notice of intent is really important, that it needs to be lodged with the super fund. We can't lodge tax returns until
you've done that,
until that notice of intent has been done. So it's super important to make sure that it's done, and your accountant will ask for it because they're not supposed to lodge a return until that's been received.
I will flag as well, if you've got HECS or HELP debt, if you do the salary sacrifice through the year, you'll get a bill at the end of the year because your employer hasn't withheld as much tax based on your overall earnings. So potentially, if you do have HECS or HELP debt, it might be better strategy to add more to super each year at the end of the financial year. Either way, all roads, we go back to Rome. Hello, Rome, what up? Your tax return and your tax file number, like the business and the side hustle, everything comes out in the wash. I always imagine a funnel, everything at the top, it eventually all comes down, the wash up. What did you earn? How much tax do you need to pay?
Exactly. Yep. And these things will help reduce the tax. But if you haven't had enough tax withheld throughout the year because of the salary sacrifice, you will end up with a tax bill, because that HECS debt, the HELP debt, is calculated based on your taxable income. And so it is really important to be mindful of all of these considerations when you're thinking about, well, do I put extra money into super? How much do I need to put? And what is the overall implication on the tax position?
Meenal, is it still worth putting extra into super if you're charged with Division 293 tax? Do you want to just recap everyone what that Div 293 is?
Yeah, so Div 293 tax is if your income and concessional contributions exceed $250,000, you'll pay an additional 15% tax on top of the normal standard 15% tax on some or all of those concessional contributions you've put into super. So effectively what it means is that the money that you are contributing to super in that concessional contribution is taxed at 30%. And so it's targeted at those higher income earners, because if you're over that 250 threshold, then you pay this additional 15% tax.
Yeah. So my own view on this, and the next question that Barbara says, when is it worth topping up your super to get a bit of a tax break? There's a couple of themes with these two things. We don't make or not make strategic financial decisions for our life solely based on what the tax thing is first. So for Barbara, she could be 100% in save mode because I'll make a scenario up. She wants to save as much money because she wants to go to Prague next year for 3 months. So she needs as much money as possible to do that, or she wants to take some leave from the workforce to start a family, so we want to pile cash. It might be more important to pile cash and have it here and pay a little bit more tax than pay less tax and have less cash. Pay more tax and have less cash. Whatever. Did I say that right? Whatever.
It all depends on your circumstances, your personal circumstances. So it's really important when you are considering whether you want to make additional contributions. First of all, look at what your situation is, look at what your income is, and then speak to your financial advisor, because they are the ones that can advise on that stuff. But, you know, when is it beneficial to top up that super to get the tax break? And so if your income is over $45,000, you're starting to move into that higher tax bracket, which is 30%. And then you also pay the Medicare levy the Medicare levy, which, you know, you're then starting to think
2%.
Yeah, 2% for Medicare. It then becomes a decision about, well, what is that longer term goal? What is it that you want? You know, it's also great for self-employed people to be putting money into super. We tend to see that super is the thing that drops off first for a self-employed person. But if you are looking for the tax deductions, it's about then putting some money into super, because what's the point of working so hard if you're not going to get some benefit out of it? And if you were working as an employee, they would be contributing the super for you. So you are being a self-employed person, it's your responsibility to then, you know, fund your retirement. So if you're looking for tax breaks, super is a great one. But it's also then about looking at, well, what is the tax bracket? What's tax effective? But it also comes back to, again, what's the strategy? What's the purpose? What is the idea that you want to be able to fund your retirement, or how do you want that to be? So there is, you know, looking at that tax break, you could use that co-contribution if you're on a low income scenario, or your spouse has a low income, you know, making sure that you use that unused concessional cap. That's a great way to get an additional tax break because you're taking advantage of that unused proportion from previous years. It's really important to just look at what your overall strategy is. And you know, if you're getting close to that 250 mark, then maybe it's a conversation to work out whether you should not put in. But the Div 293 tax can actually be paid from the super fund as well. So it doesn't...
Or out of your bank account.
Out of your bank account. So it doesn't necessarily come out of your pocket if you don't want it to. So maybe your strategy is that you put this additional money into super. Yes, you have to pay the Div 293 tax, but the super fund's going to pay it. Overall, that is still a lower tax than what you would be paying in your own personal name. So looking at those marginal tax rates.
Yeah, and for the casual observer, superannuation can get complicated fast, and there's kind of this 3 major tax rates in super, 15% or numbers, 15%, 30% and 0% for pension phase. But there's this 15% internal tax rate in your super that any income generated, it's taxed at 15% internally. But it's also 15% is the tax rate that the government taxes you when you put money in. So to Meenal's question, is it still worth putting extra into super if you're charged an extra 15%? And this also goes to Barbara's question, if I may digress. When we talk about these potential ways to reduce tax with super and, I'm going to put more money into super so I can save less tax, so I can pay less tax, do you have the money to actually put into super? Have you got your budget and cash flow locked away? Have you got your financial goals rock solid? You might have $1,000 in your bank account, but if Rego's due next month, well, no, we've got to pay Rego. So it is about having your system set up and knowing that, okay, I've got X amount left over in my life each month. On this Div 293, if you have all your budget and spending plan in place, you've got your insurances, your sound financial house, you're out of debt, you've got your emergency fund, and you want to build wealth for the long term, if only there was a long-term investment account that was tax effective, already set up, ready to go, aka superannuation, what I'm kind of thinking, and this is my own view, if you are triggered with the 293 tax, your income is over 250, which means your tax rate out of super is 47 plus 2, 49, call it 50%, call it 50. On income and money that you receive, here's a question. Do you want to pay 50% tax or 30% tax? I've taken the view that I'm happy to cop the 293.
Exactly, because it's a lower tax rate. So again, it's important to make sure that, like all of those things you just spoke about, that the cash is allocated. You've got your systems, you've got your processes, you've got your plan in place, and this is surplus cash that you don't need, because remember, when you put money into super, it's locked away until that time when you're able to take it out, which, as you said, super is very complicated, and there's a whole heap of rules as to when you can take the money out and the transition to retirement and all of those things. So it's really important that if you're going to make a contribution to super, you understand that the money's effectively gone. You don't have access to it. So if you can do that, if you're comfortable with that, it's definitely better to look at paying 30% tax rather than 47 plus the Medicare.
Yep. Okay, Dokale. Nick, will the 20% HEX deduction be applied before or after current financial year repayments are applied? So Anthony and the Labor Party are back. They've said we're going to wipe 20% off everyone's help debt balance. When are they doing it?
So the tax office are going to apply this 20% reduction to all the training and study loans that are there as at the 1st of June 2025. So Parliament is meeting on the 22nd of July to introduce this legislation. If that gets passed, then they will apply that reduction as of the 1st of June. So it's really about the amount that you want to repay, or that you have to repay, is based on your taxable income at 30 June. And therefore, it's applied after you lodge your tax return, which, if you want to get the maximum benefit of this 20% reduction, then probably wait until after 1st of June to make any repayments because 1st of June is when the reduction is going to be applied to.
Yeah. But the thing is as well, with these type of things and with when they change the index rate from just CPI to the wage price index or CPI, whatever's lower, they backdate it anyway. So I don't think you need to be that worried.
No, and look, it all comes out in the wash eventually anyway. Again, if you've got additional funds available, it's about the question, do I make a repayment? Because that's going to reduce effectively the interest, which is like this indexation.
Yep.
What's your cash flow like? There's other factors that need to come into it as well, rather than just trying to beat the tax office all the time.
100%. Chris asks, can you claim work-related education expenses like short courses?
So this is a bit has been a bit of an issue in the past because people think that you just do a course and you can claim it. But you actually need to meet some criteria in order to be able to claim things. So you can claim it if the course that you want to do maintains or improves your current skills or knowledge, and it's likely to lead to an increase in your current job. So it needs to be related to your current role and not a future one. So
Chris could be a metal fabricator and wants to take up hairdressing in 3 years' time.
Yeah.
Don't do a hairdressing course now and think you can claim it on tax.
Exactly. But if you're a marketing coordinator and you do a short course on how to do advanced digital marketing, that is related to your current role, so that is okay. So it's really looking at, well, what am I currently doing? And is this course related to an increase with this current job? So you can't claim it, though, if it's intended to help you get a new job or to start a business, which seems a little unfair because, you need to do some training to be able to get a new job.
Chicken or egg?
Yeah, exactly.
What did come first? Did we ever work that out?
I've got no idea, but
All right.
It's a good question though, isn't it? Because it is really hard. How do you get yourself into getting a new position if you don't first do the courses? But the tax office and the way that they claim deductions, there has to be this nexus between what it is that you're earning, and you can claim anything that relates to generating that income. So if you've incurred it in producing that income, then it's a deduction. But if you haven't actually earned any money in that space yet, then you can't claim anything in relation to that.
I've actually got a good idea if people want to upskill in their current role. And I said to my team the other day, we had a team week, and I'm like, all right, if you want to do any course, you research it, provide me with the details. So if Sean wanted to do an advanced Premiere Pro or After Effects maybe not so much After Effects, or insert course here, send it to me. I'll have a look at it. If I think it's beneficial, me as the employer, I'll fund it, number one. Number two, I'm happy to do that if it's reasonable. Like if it's a $10,000 thing, probably won't. But it is a way that people can look to extract extra value out of their position if pay rises aren't on the table, because there could be L&D budgets available. So one, can your work pay for it? Number two, can you strike a deal with your employer? Hey, I want to do this course. What about if I pass, would you reimburse me? Or if I pass, we'll go halves.
Yeah.
So, and then that removes, well, if they fully fund it or reimburse it to you, we don't have to claim it.
Exactly. And that's one of the criteria too. You can't have somebody else pay for it and you claim it. You need to pay for it if you want to claim it as a deduction.
And as a business owner with employees, it hurts my little soul a little bit that if I was thinking my team were paying out of their own money to do a Premiere Pro course,
that's going to benefit your business and improve.
Where I'm like, oh, can I just pay for it?
Yeah.
However, this is where it gets interesting. If I did pay for a course and someone wanted to do it and it was development and it was $2,500, $3,000 course, I would literally have some strings on it. Like, I'll do this, but if you resign from your role in the next 18 months or 2 years, I'm clawing half of it back or something like that.
Exactly.
Because it's an investment. So
Yeah.
it is a dance. So I just thought it's an interesting thing there.
Yeah, and I think it definitely, I think when you get those really good employers that are wanting to support and help their employees get the best out of them, because when employees are happy and they're engaged and they're learning, it's going to be beneficial for your business too. But there has to be that trade-off. So,
And I guess if it's a business when there's like no budget for it and you want to work on your career, on one hand, my soul hurts that, can't the business just pay for it? But also amazing that you've taken the initiative, you've invested in yourself, because the best thing you can do is invest in yourself, upskill, sure, grab the deduction along the way, then bounce into the next role.
exactly.
The current role that you're at might not be it. So awesome. We will be right back after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
All right, let's get down and dirty in finishing. Hendrik, can you use last year's capital loss to offset this year's capital gain?
Yeah, so capital gains is a tricky beast itself. We seem to have a few of these today, super and capital gains. But yes, capital losses can be applied to capital gains. Capital losses are different to the normal loss like we were talking before. So it can only be applied to a capital gain. There is some tax planning that can happen around this to make sure that you are fully utilising the capital losses, making sure that if you're going to have a capital gain in 1 year, you do the loss or you have a loss first and then you have the capital gain.
Yeah, so if someone had 2 investment properties, one was a dog, we're going to lose it at a loss, we're going to sell it at a loss.
Sell that in 1 year and then sell the next one in the next financial year, then you can apply that loss to the capital gain.
Or the same year.
If it happens in the same year, then it's fine. It doesn't need to be one first. But if you're looking at 2 financial years, then definitely sell the asset that's going to generate the loss first. That loss is quarantined until you make a capital gain, and then you can apply the loss off it.
So I always remember a capital loss will go with you to the grave.
Yeah, so make sure you keep really good records. Make sure it's included in your tax return. There's a spot there that it is carried forward.
And so if I had a capital loss of $100,000 this financial year, do I have to mention it ever again? Or if it goes in my tax return now, the ATO will have it flagged in the background in 5 years' time. If I did sell a property for a gain of $100,000, it would just get wiped off.
No, you still need to apply that loss against the capital gain. It does.
So they don't remember it against your ATO.
It does show on your pre-fill report from the tax office, but it isn't
Every year though?
Yeah, I think it does.
Yeah, okay.
I think it does. But it doesn't get automatically applied until maybe somebody reviews the return way down in the future. Who knows when that's going to happen?
Right.
So yes, it shows up on your pre-fill, but you have to then apply it to the gain that's actually made.
So that's important to know. If you do have a loss and you get a bonus at work, 20 grand bonus, and there's a loss there from your investment property that was horrendous, you can't offset the 20 grand bonus because that's income, it's not of capital nature. And a little fun learning fact, if you have a discretionary trust that has assets or investments and there is a loss in that trust, the loss is stuck in the trust. You can't distribute a loss to individual beneficiaries.
No, correct.
Okay, moving right along. Rowan, I've sold some shares this year. CBA held for 25 years. DRP makes establishing a cost base a nightmare. Any advice? Good luck. Next question.
I know. It's these DRPs are really a nightmare.
Gosh.
And this, that's the whole strategy of investing for a lot of people, right? They just keep putting these DRPs in place. So technically you are supposed to keep record of all of these DRPs, whether you get 2 or 3 shares, maybe it's even just 1 share each time there's a dividend. There are some sites that can help you generate this sort of stuff. There's a platform called ShareSite, which provides you with some pretty comprehensive historical data. There is some thresholds depending on investments that you hold as to whether it's free or
I think
not.
you get 10 holdings for
Yeah,
free.
but
It doesn't help when it's 25 years down the track. It's more of a forward planning thing now, isn't it?
Exactly. But, I think when you have shares, part of that is a responsibility to make sure that you keep appropriate records.
So on that, Rowan's had CBA shares held for 25 years. I go out on a limb, there could be significant value there, okay? There could be 300 grand worth of CBA shares. We don't actually know. I'm making a number up. You basically, if Rowan rocked up to your practice and said, here we go, it's literally like, okay, well, you've got no records. We'll log into the registry and see what we can find. We have to make some conservative assumptions for the ATO.
Yeah, look, if that happened, first of all, I'd have a little cry because it's like, that's a nightmare.
But
like
Rowan, because of that, one of my points was there could be a few $1,000s worth of accounting time and fees.
Exactly. But given the value of the shares and the capital gain that's likely to happen, it's really important to make sure that we get the cost base. So even if you were able to provide the initial number of shares purchased and the date the shares were purchased, that is a really good start because then we can work out what the dividend reinvestment was each time. And work out a very long spreadsheet to be able to update that. Gets a bit more complicated when you are buying and selling throughout the time. But, at least if you have that initial purchase, that's a really good start.
I'm just, for fun, I just brought up ChatGPT, see what they say, right?
Yes.
I
That
purchased,
good old ChatGPT.
That's always wrong. Here's this. How's this, rather? ChatGPT is good, but if you don't know what you're freaking talking about to start with, there's so many mistakes in it. So don't rely on it, people, for stuff. Let it do some heavy lifting, but
But then you need to do your research.
Well, you've got to know what you're freaking on about.
Exactly.
I purchased $10,000 CBA shares in Australia in 2000, just sold them. There was DRP along the way. What is the value today if sold, and what is the cost base for because it's after pre-CGT flag anyway, so there's a real one in the boat. What is the cost base for the parcel assuming DRP? We might break the internet now. Let's have a look. And that speaks to why going forward, like I don't use a direct CHESS-sponsored broker. I use a platform because I just want all the records to be rock solid. All right, here we go. G'day, Glen. You've done well holding onto those CBA shares since 2000, especially with the dividend reinvestment plan. And if you are watching on YouTube, I will share this because we are doing more of a show now for YouTube. And thanks for listening, obviously, if you're on Spotify or Apple. So I've shared ChatGPT. Initial investment, $10,000. CBA share price in 2000, approximately $25 per share. Initial shares purchased, $10,000 by $25 equals 400 shares. Auto switch. Participating in the DRP means that instead of receiving cash dividends, you received additional CBA shares. Over 25 years, this compounding effect can significantly increase your total shareholding. Thank you, Captain Science. While exact figures depend on dividend amounts and share prices at each reinvestment point, historical data suggests that a long-term DRP participants could see their shareholding increase by approximately 2.5 times over 25 years. Estimated total shares in 2025, 400 initial shares times 2.5 is 1,000 shares. Bit of a summary here. CBA share price in May, approximately 175. We're at all-time highs. Total value, 1,000 shares times 175 is $175,000. Calculating the cost base for this CGT, initial purchase cost, $10,000. Cost of DRP shares, it's considered a separate purchase. So the cost base for these shares is that their market value at the time of each dividend reinvestment. Yep, we know that.
Yep.
Accurately calculating the total cost base requires detailed records of each dividend reinvestment.
Did we just say that?
Yep. Including dates and the share price. You've kept these records. You can sum the market values. If you've kept these records, you can sum the market values of shares acquired through DRP to determine or to estimate. Okay. Estimating the capital gain. Total proceeds from sale, $175,000. Let's assume that approximately $40,000, including initial investment and DRP shares. So capital gain equals $175,000 less $40,000 equals $135,000. Note, this is a simplified estimate for precise calculation, especially for tax purposes. Consult with a tax professional or financial advisor. Key takeaways, investment growth, your $10,000 potentially grew to $175,000 over 25 years. All that to say, it was useless.
Keep good records.
ChatGPT was basically useless.
Yep.
Now, I don't know, that was just fun. Whatever. Sue me. Don't know where we got there, but anyway, any advice? Yeah. You're going to have to pay an accountant to sit down and do some detailed year-on-year assumptions. They may go back. Look, there is a detailed search function on ChatGPT. It might take an hour to search, but I think it's a manual thing.
The message is, though, that it is going to be quite detailed. It's going to take a long time. It's going to cost you a bit if you don't have these records because it is a long process.
150%. Stu, do you have to wait for your share platform's end-of-year statement for your tax return, or can you figure it out early? Well, 100%. If it's a platform like Superhero, Sharesies, Beta Shares Direct, if you've got a wrap account, 100% you are, because that's why you have the platform, right?
Exactly. And, some of these distributions you receive throughout the year, part of it is tax-free. So if you were to just go and put the actual cash distributions you've received in your tax return, you're not actually reporting things correctly because you can be receiving, say, foreign investment income, you can receive dividend investment income. There may be franking credits attached to it. There may be capital gains, which are then subject to the CGT discounts that are available. So if you are using a platform, we tend to say wait until they come out, which usually is around the end of September. So if you're wanting to lodge your tax return before then, just hold off, just don't do it because we need to wait for those tax statements to come through.
Yeah, and within that, it's kind of the reason that you should just wait 10 minutes until after the financial year before doing your tax return. You could have your shares and ETFs on Superhero, for example. What if you've got BlackRock ETF, Vanguard ETF, you might have a VAP REIT, okay? You might have VAS. You might have some direct individual shares. You might have some State Street stuff. You might have some Global X stuff. the platform won't be able to give you your full tax consolidated statement until all of those individual ETFs have done their end of year statements. So it could be, you might have one REIT, for example, that they're not sending a statement until 30th of October, and Superhero or insert platform is ready to go, but they can't because they can't plug in all the holdings to your report.
Exactly. And I suppose, like, if you are investing in these platforms, you're a bit more of a complicated person in a tax return space. You're not just got wages and salary or a bit of interest. You're actually doing something that's more complicated. And when you do that, there are implications. You are making more money, you are doing different things. That's just the outcome of having these investments. And I think it's just about accepting that you just can't do your tax return on the 5th of July if you have investments. And also too, if you have like interest or individual shareholdings with your dividends, those things take time as well to log on to the tax office pre-fill report. Again, so if you're lodging very early in July, it's potential that you're going to miss some of this stuff, and the tax office will cross-match and they'll send you an amended assessment. Could be 2 years down the track, but you'll get an amended assessment. So I would just hang off, just sit tight for a hot little minute, and then it'll be, all the information will be there.
And I was just actually thinking, like if you had Superhero, for example, and then on Superhero you had VAP, which is the Vanguard Australian Property Index Fund. For example, they've got a holding in Dexus and all these other REITs, because it's a REIT of REITs, basically. There could be one of the underlying REITs that Vanguard is waiting for details before Vanguard can do the statement. Then Vanguard can do the statement and then send to Superhero.
Again, how complicated is that? It's not just a straightforward process. And I think that if you are investing in these type of platforms or these investments, you just need to accept that you need to wait for a moment.
Yep. The business end of the deal, couple of quick business questions. Dave, what up, Dave? If you move from a sole trader to a trust, do you need a business valuation, and will it trigger tax issues? Look, you could probably ask that question if we move from a sole trader to a company trust or a unit trust. We're restructuring the business. I'm going to shut up now because I know enough to be dangerous, but surely there'd be some type of exemptions.
Yes, so there is a small business trust restructure rollover, which allows you to go from a sole trader to a trust without triggering capital gains tax.
Can that be a unit trust or a discretionary family trust?
Yes.
Okay.
You then...
That was a confident yes, was it?
Yes.
Check with your accountant, everyone.
Check with your accountant. Look, these type of things...
Sorry, it's the end of the episode. No one listens here.
Goodo.
Yeah.
It's a very complicated area.
Yeah.
So if you are in this space, then you need to be seeking advice because it's very specific. But generally, if you are moving from a sole trader to a trust, then you don't trigger the capital gains tax, which means that you roll over the cost base from those assets you had and put them into the trust, which defers the capital gain. So there's a few conditions though. There has to be no ultimate change in the underlying ownership. So the same family,
beneficial owner.
The same family is still the sole trader is now the trust. The restructure is genuine and it's for commercial reasons. So there's you need to make sure everything you do has commercial reasons, and these assets in the business are actually active assets. But to answer Dave's question, yes, you will need a valuation because you need to help determine the market value of that stock. It's not the cost that you actually paid for it, it's the market value. And that could be goodwill as well, which needs to be transferred to the new structure. So yes, you need to definitely make sure you get a valuation.
But that could be
it doesn't need to be
you don't
like
have to pay a value of $5,000. It can be
No.
just like, okay, here's the stock at value. We own some other equipment.
Maybe it's
goodwill.
engaging a real estate agent. If you've got some property there, maybe it's 3 or 4 agents to get an idea of the value of the
But
property.
that's a broader discussion because we're not moving a property into a trust and trading
No,
out of the same.
but
Anyway, but you vibe me.
You know what I mean.
Yep.
It's about, how do you come up with what's a reasonable market value?
Yeah, just so if you get a please explain in 5 years' time.
Exactly. You need to have the paperwork and
Yeah.
you need to have it very well documented as to, well, how did we come up with this? And when you have those commercial reasons as to why you've done something, the paperwork needs to support it, because effectively the onus is on you as the taxpayer to prove that this is is why we did it. This is the reasons and this is the value.
Daniel, does business income affect your or your spouse's personal income tax? Well, that's a $1 million question, isn't it?
Yes, it does. So business income, if you're doing this under your tax file number, that gets added to your other income. So
when you say doing this under your tax file number, is that AKA a sole trader?
Sole trader.
Yep.
So if you're a sole trader, then yes, say you've got a small plumbing business, but then you also work as a plumber for an employer. So you get a payment summary, you get weekly wages, but you also have this business on the side. All of that net income from the business gets added to all your other income. So that then is what's taxed. Now, you may find that you end up with a tax bill at the end of the year if you haven't been paying PAYG instalments throughout the year. So that is just an instalment of tax that the tax office want every quarter, because they're not getting tax from the employer every week or every fortnight like what you do from your wages and salary income. So yes, it does impact your tax. You need to be mindful that you may have a tax bill at the end, particularly if this is the first year. If it's an ongoing thing and you've had it in the past, then I suspect you would be paying instalments throughout the year, which means then the tax is pretty much covered. And yes, it will impact, it doesn't specifically impact your spouse's income, but combined income determines like your private health insurance rebate, Centrelink benefits, family tax benefits, childcare subsidies, the Medicare levy surcharge. So yes, this, while it doesn't directly impact your spouse's taxable income, it does through these other things.
Yeah, and that's it. It's and that could be one of the reasons, Dave is moving from a sole trader to a trust. Dave's partner, if he's got one, might work in the business as well, and
it allows for some income splitting.
Yeah, we've got some
some
razzle dazzle happening.
Spread some income that way.
Finally, work from home. Over the last 5 years, there were some changes. With COVID and a statutory cents per hour of working from home. Blah blah blah. If you are working from home, how do tax deductions work, and what work from home expenses can you claim? Electricity, internet, depreciation. Someone else wrote in the group after I'd kind of sent you these questions about if I working from home in one of the bedrooms, can I claim that room on tax? Blah, blah, blah.
Yes.
I'm going to leave that with you and I'm going to go and get a coffee.
Oh, well, let's open a can of worms, right? So there are 2 methods that you can claim working from home. The first one is that fixed rate method, which you said. That's currently 70 cents per hour, and that covers all of the expenses. So that bundles everything together. That's the gas, the electricity, the internet, the home phone, the mobile phone, the stationery, the computer, consumables. And you end up with how many hours you've worked. Apply this rate to it. That's the deduction. So you don't need to keep all of these bills. You don't need to keep those records, because the only thing you need to keep is the hours that you've worked. So diary entries, timesheets, rosters, calendars, whatever that looks like, because again, if the tax office ever come and ask, it's on you. You have the onus to be able to prove how many hours you've done. So you just need to know how many hours you've worked. You can claim depreciation on your laptop and your monitor. You can claim the repairs on those things separately. But for all of those expenses that I mentioned before, you don't then claim that separately. So that's the first method. The second method is the actual method, which tends to get a lot more complicated because
Is it right to say the actual method, you might end up getting more back, but you
Yes.
have to work harder for it by
Absolutely.
keeping records and all
Yep,
that? Yeah.
absolutely.
You got to work for your dinner, kids.
Yes, it's not just a free ride, right? So yes, you claim a proportion of all of those expenses based on the usage. So you need to keep receipts for everything. You need to keep a lot more detailed records.
Good England.
I know,
Hey,
sorry.
we are recording this, everyone, on a Friday freaking afternoon because it was the last minute.
It's been a long week, right?
Yeah, it has. It's been a long life.
Yeah. And now we're talking working from home deductions.
I know.
Yeah. So actual method, you need to have your records. You need to keep very detailed reports on, again, your hours that you've worked, but you need a logbook. So you need those receipts. You need to keep all your gas and electricity. You need to keep all your internet, all your phone bills. You make sure, though, you don't include things like tea and coffee or rent or mortgage unless you're self-employed and you've got that dedicated home office. So that's different. You can't claim your work clothes. So really we're just talking about the office space of actually using this space within your house to claim it. Another thing you need to be careful of is travel deductions when you've got this working from home. Travel is normally not deductible between home and work. If you're working from home, that determination can get a little more tricky because you need to work out, well, where is the actual base for your employment? And so are you working from home just a couple of days from a week, but the office in town is the actual office? You're just choosing to work here for a couple of days. So therefore, if you go in for a meeting, that's not deductible because the office—
That's your office.
That's the workplace.
Yeah.
So if you don't have an office, if you don't have anywhere else, then, looking at your personal circumstances, is this your place of business? Then possibly you can claim some travel. But that's a conversation to work out exactly.
This is highly, in this hybrid workplace environment that we are living in, this is such highly personal, circumstantial. Like, here's the thing. If you're self-employed and you work from home and you rent, you could claim a square meterage of your weekly rent. But you wouldn't potentially do that if you own the property because it's going to dick with your cost base for
Capital
gains tax exemption.
So you don't want to jeopardise your principal place of residence.
Yeah.
So it is really quite complicated. That's why a lot of people just go with the cents per hour method.
Now, any other kind of comments on that cents per hour versus like statutory, I think you would call it, cents per hour method versus the crunch it, spreadsheet it? I mean, at least do something if you are working from home.
Yep. How much detail or how are you with attention to detail?
Not great. No, I am for things that matter.
But that's the question,
Yeah,
right?
the
Like
question
you
to
can't
everyone.
half-ass it. You've got to do it right.
Yeah.
So are you prepared to put in the work? Yes, it may be a bit more work, but it could end up being quite a significant deduction.
Did I hear, and I haven't crunched this, but if you did the nominal 70 cents an hour, it's like an 8 hours from home or something. It ends up being like $80 a year or something like that. It'd be really easy to crunch, but
Yeah,
it's
look,
not.
it's
This
not
is not
huge.
game-changing money.
No,
but
it's
it's
not
available
massive.
to do.
Yeah, absolutely. And if you are working from home a lot, then, it's money for jam, right? You're entitled to it, but you need to keep the records. Like everything, if the tax office ever ask about any of your deductions, you have to substantiate it. So how are you going to do that? What are the records that you have? So, yeah, it doesn't end up being a huge amount, but anything is better than nothing. We obviously don't want to give the tax office more than what we should and claim what we're entitled to. But just make sure you've got your records. Like, that comes down to all of this stuff, all your deductions. Make sure you've got your records. You can't just put in this nominal $300 and claim that.
And that's a good segue into Albanese's promise if he was re-elected with the $1,000 deduction, which I'll just update. But one thing, AI is good for, just while you were finishing, I typed in, if I work from home 5 days per week, 8 hours a day, 48 weeks a year, how many hours and how much if I could claim 70 cents per hour? So this is full-time work from home, going to town, baby. 5 days a week, 8 hours per day, 50. It's basically 1,920 hours times 70%, $1,300. So it's
decent.
It adds up.
Yep.
Maybe I was thinking around $80 a month. That's where I think I got the...
Yeah.
Anyway, so back to the Albanese government. If they got re-elected, they were going to apply a $1,000 instant automatic deduction for workers, and he has been re-elected. We will assume that the bill will get passed, receive royal assent, blah, blah, blah. So that would start on 1 July this financial year, or this year, 1 July 2025. And that would mean for next financial year tax return, as it stands today, you could add that $1,000 deduction. Now, a couple of things that we know, and again, this could change because it's not put to bed yet. You can't claim additional work-related expenses, including work from home, if you use this $1,000 deduction.
So therefore, if you're working 5 days a week, 40 hours a week,
you would use the 70 cent.
You would use the 70 cent method.
Yeah, because you would be able to claim that
$1,344,
which is more to claim than $1,000.
Yeah.
But who knows? They could end up dicking around. Like they could end up saying, we're scrapping the 70 cents. We're just doing the 1,000. Or the DIY track your own. So if you do the DIY track and crunch your own, you can't use that and the $1,000 thing. Like you can't use 70 cents an hour and DIY.
Right. Yeah.
So I have a strange feeling in my very limited research that maybe they might have that 70 cents on the chopping block, but we won't know. But
that's the thing. Until things are legislated, things can be talked about for a long time. Like the instant asset write-off, usually you hear about it the last few days before June. What's the actual threshold amount? So that makes it really hard to be able to plan for what am I going to spend my money on in a business to be able to get the full instant asset write-off. Makes it really hard to plan. So yes, some of this stuff has been talked about, particularly in the election, but until it comes in, let's just work with what we've got. This is what we know. And just go from there, because it's really hard to make those assumptions because we don't know what it's going to look like.
Absolutely. So we have covered a lot of ground. The only thing, this episode is going up at the start of June before the end of the financial year. If you are making extra payments to your superannuation, do not freaking leave it until the last week in June.
No,
do it
mid-June.
now, because the amount of probably in actual theory and in actual practice and all that stuff, you probably need to do it 3 business days before the end of the financial year. But for the avoidance of doubt and me telling everyone what to do it the start of June, because there's just processing time. The amount of people that on the 30th of June say, I've just transferred $1,000 to my super, that's cute. 5 p.m. that day, BPay will actually execute it. It's going to land in your super fund on the 3rd of July. Then they'll look at it and go, okay, we see it on the 3rd of July, but it was credited back to the 1st. It's not going to be this financial year.
And super is really dependent on those dates.
Yep.
So we tell our clients mid-June at the latest.
Absolutely. To
get things processed and make sure you're on time, because if you don't, then you're potentially missing out on using this additional unused carried forward cap.
Yep.
You're missing out on some of these non-deductible contribution cap limits. So super is something that you really need to pay attention to. If that's in your field, like in your scope and what you're looking at, make sure you know the detail.
And I think as well, like in rounding this out, in terms of a time critical thing, if you are planning on paying $500 on a course to do in July that is related to your work and you can claim it, I personally would just pay it in June so I can claim it this financial year. If your situation works that way, you might have a lower income next financial year, so it might be better off to claim it this financial year. For the business owners, I kind of, it's into June now. I'm kind of like, all right, what do I need to actually buy? I've just renovated.
Don't go and spend money just for the sake of it and just to save tax. There has to be a reason as to why you want to spend the money. And, we tell our clients with our tax planning that what do you need to buy? Do you need to invoice before June or can you delay the invoicing? But everything has got to have that commercial underlying basis for it, because what's the point of going and spending, thousands of dollars worth of money to get some things that you don't necessarily need or want just to get the tax deduction.
Yeah, so effectively, so like I'm, doing some work here and buying some odd things. I've got to spend the money anyway. As a business owner, I'm like, I'll pay it in June, claim it. It might reduce my profit this financial year, but at least I'll get it all done. It's in June. I'm doing it anyway. But yeah, I'm glad you brought that up, because if your tax rate is 30%, okay, and you're like, I need to buy something to reduce my tax, it's not pay $1,000 item and then when I do my tax, the government gives me $1,000 back. Effectively what it is, because I saw a sign at JB Hi-Fi, like tax time deals. I buy $1,000 item. The wash up is I get 30% back.
Yeah.
My tax rate.
Yeah.
So would you rather have the item and save $300 or keep the cash, pay the $300 and you've got $700?
If you don't need the stuff,
the government
save the $1,000 and pay and end up with $700. If you need it, then that's a different story. But don't go and buy stuff just for the sake of it. I think we have this real aversion to paying tax. You obviously don't want to pay more than you have to. You don't want to pay more than you should. I totally get that. But don't do everything based on what the tax implication is.
Yeah.
It needs to be a commercial decision. You're running a business. You're, even if you are just a sole trader or an individual who...
Well, even run your individual life like a commercial decision.
Exactly.
Do I have the money to put into superannuation?
Yeah. Make it, take control of your money. Get into this space where you have confidence to be able to make these decisions. Is it a good decision? Or is it just I'm frightened of the tax, I don't want to pay tax, the tax office scares me, all of these things and all of these emotions that drive the decision, take that out and is this actually a good decision or not?
110%. Erin, so much for when I said, I'll probably be 45 minutes, an hour. We're here now. Where can people find you again on Instagram if they want to follow you?
Erin Davis Money, or you can catch me at erindavis.com.au. I'm on Facebook as well, LinkedIn. There you go. Around Newcastle.
There you go. All right, everyone. You've been real. I've been Glen. This has been Erin. See you soon. Bye. Oh, if you have found this episode useful or valuable and you're still listening, can I ask you to please send it to a friend or family member, or give us a rating or a review or a like on YouTube. See ya.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.